Okay, thanks for joining. Welcome back to the channel. Today, top movers and fallers. I sold one stock and one dividend payment that I've received this week. So yeah, like up the video, subscribe, ring that notification bell, and my link will be down below, freetrade.io/infant-investors. Click on the link, sign up, deposit £1. You'll get a free share of up to £200. Let's get straight into the top movers. The first top mover to talk about is Okta. Now, incidentally, Okta's only ended up 0.64% up by the end of the week, so that's obviously extremely negligible for a growth stock or a tech stock. So there's not really any news surrounding Okta as to why it's moved basically sideways this week. So I'm just going to keep it moving from Okta now and move on to the next stock, which is Cloudflare. Cloudflare has gone up 5.65% this week. Now, the only news pertaining to Cloudflare as a business in terms of products or services or things they might have done is the fact that they've teamed up with the Internet Archive. For those of you that don't know who the Internet Archive are, I don't know if you've ever heard of a website called Wayback Machine, but basically you can put a URL in and you can find out what a website used to look like back in 2013, 2014, 2009, or however long ago since it was actually archived. So basically, Internet Archive and Cloudflare have teamed up to basically archive content of websites that use Cloudflare's always online service. So websites that enable Cloudflare's always online service will now have their content automatically archived, and if by any chance that the original host is not available to Cloudflare, then the Internet Archive will kick in and obviously restore that backup information for users. So I think it's a good product enhancement and feature. Is it enough to materially have moved the stock price up this week by 5%? Remains to be seen. One of my other theories of why Cloudflare has gone up is quite considerable, or just basically simply due to the fact that Cloudflare has gone down quite considerably this month. And because of that, I think people are seeing it as an opportunity to buy and enter into this stock. So that's also another theory that I have relating to Cloudflare. Now, the top mover for this week is Tesla. Tesla's gone up 13.61%, and it is all in anticipation for Battery Day, which is coming next week on September the 22nd. So some analysis firms have basically raised their price target, some around the 475 mark, some even as bullish as the 515 mark. It's all about the batteries, really. It's all about the batteries in this Battery Day announcement. The name says it on the tin, but there's a few things that I think people are expecting that is worth looking out for. So the first thing is about the density of batteries. So the amount of energy that's basically stored. Now, if you look at the Tesla Model 3, it's around 250 watt hours per kilogram. There's basically, murmurings or people anticipating that Tesla will talk about an unveiling of a 400 watt hour per kilogram. What that basically means is that it can store a lot more energy, and that therefore can be used for, longer journeys, but also things like even airplanes. It's enough energy to potentially fly an airplane using purely electric means. So that's going to be interesting to see if there's something they're going to announce. It doesn't mean if they announce it that means they're launching it at that moment, but it might be that it's in production and it's set to have a date to launch, which could be at some point in, say, 2021 or beyond. The next thing is about their tabless electrodes. So effectively, this is all about how they reduce manufacturing costs and reduce resistance costs. Ultimately, you have to look at Tesla's battery business not just from what the impact is to consumers, but also how it can also optimize in terms of their overall cost base as a business. So if they can reduce their manufacturing costs, if they can actually produce more batteries that are longer lasting at a quicker pace, then obviously they've got a stream of products and services that they can not only put in their own vehicles, but they can also sell to other people as well. So this tabless electrode is potentially an opportunity that will allow for a more improved supply chain system. They talked about their Roadrunner conveyor belt system that might actually be announced as well, which is showing that they can actually really increase the velocity of all of their production. The next thing is about the million-mile battery, which has been talked about quite heavily. So this battery is effectively more durable, it allows for more aggressive charging, longer range, it's smaller sizes, and again lower in cost. Now, the average Tesla driver, the average user, actually charges their battery about 50 to 100 full cycles. This battery will effectively allow around 4,000 cycles, so it's a considerable amount more than what the average user is effectively going to ever need. And so the assumption here is that this battery is going to be for fleets. So when you're thinking about buses, fleets of vehicles, trucks, renewable energy storage for homes and so forth, that's effectively the biggest use case and the biggest value driver for these, batteries and products. So if all of this stuff manifests, again, a lot of this stuff is a bit, hyperbole. Some of it is leaks, some of it is, valid information, but, it's all across there. So definitely go and check it out. But if a lot of this stuff manifests, then, people will be a lot more bullish on Tesla again. I mean, I don't know if you can get more bullish on a stock like Tesla because, look what it's already done, 800% this year or something along those lines. Yeah, 800% this year alone. So I think it's going to, again, reintroduce the fact why that Tesla is probably a 1 in a million type of company and type of business. Now, I know a lot of you, I've been talking to some of you guys in the DMs about the fact that I bought Tesla recently, and the question's been asked, do you regret not getting into Tesla earlier and so forth? And I don't actually regret it. Like, at the end of the day, for me, there's so many opportunities within the market, and even if I don't invest in a certain business, I've traded certain businesses where I'm not investing in it and made profit, via day trading and via swing trading and other means as well. So me personally, I don't ever regret a decision, because for me, I always know that when I make a decision, I'm making it based off the informed information and data that I've got at the time. I generally felt that when it was 500 a share, it was a bit too high of a valuation. When it was 800 a share, it was too high. No one anticipated it going to 2,000 a share before, obviously, it then, did a stock split. I've decided, obviously, to invest into Tesla now, primarily on the basis that when I'm looking at it long term, even though the valuation for me is still pretty rich, and so if the stock was to drop and fall down, I actually wouldn't even mind. I'm just thinking of it now as certain stocks that I'm investing in, I'm purely thinking of 5 to 10 year plays. Like, I'm not thinking about the 1 to 3 year horizon that I originally had with the value stocks that I originally invested in at the beginning. So because the horizon is a lot more longer term, then I think irrespective of what price I get it at, it's always going to be beneficial in the long term for me. So yeah, and I think it's obviously, generally a good business. And when those batteries and when those the solar power and the renewable energy actually comes into play, the full self-driving fleet, when these things actually do come into play, then hopefully it's going to be a big deal. So I thought, what, it's a good time to get in at this current moment now that my strategy has slightly changed. But yeah, that's the top movers for this week: Okta, Cloudflare, and of course Tesla. Now, top fallers. The top fallers for this week. The first one to talk about is Legal and General, gone down 1.71% this week. Overall, the FTSE 100 has ended badly, and it's predominantly due to the fact that the UK government is considering a second nationwide lockdown. So that's had a bit of a stressful time in terms of UK businesses and stocks. Airline and travel stocks have done terrible this week because of that news. But a lot of stocks, to be fair, have had a bit of a bad time due to that news and what potential is going to happen for that. The same has happened to Lloyd's, which is obviously the second top faller. And obviously you can see here that it's gone down 4.27%. And again, it's for the same reason. The only additional thing with Lloyd's, I would say, is that there is some hedge funds, one particular called Marshall Wace, which is a $49 billion London-based hedge fund. And they've taken out a short position on Lloyd's. So they've taken out a short position on the UK's biggest bank and biggest lender, which is an incredible vote of anti-confidence, shall I say, against, the UK economy as a whole, because Lloyd's Bank is typically seen as a representation of the UK economy. So it's a big short against the UK economy long term, and it's a big short, obviously, against this specific bank and this specific stock. So obviously, that's not good news. That's not good news for me. That's not good news for anyone that is a Lloyd's investor. I still think you just have to be extremely and excruciatingly long term with Lloyd's. So I'm still waiting for the fact that when they reinstate their dividends, if I don't see a 40% increase like overnight, I'm talking that week, I need to see a 40% go up. And that's what I'm expecting when the dividends start to get reinstated. The amount of institutions, pension funds that rely on those Lloyd's dividend payments for their clients and for their businesses, as well as obviously individual investors, is humongous. And so I'm just anticipating that once Lloyd's gets into a place where they are announcing, look, we are going to start paying dividends again, people are going to want to get that quarterly dividend payment and actually trust. When you actually look at the balance sheet for Lloyd's and the fundamentals, which you just always have to do with, being an investor, Lloyd's balance sheet and fundamentals is I don't want to say fantastic, but it's great. So there's nothing fundamentally about the numbers in Lloyd's that's actually causing any concern. It's just the UK economy as a whole is just tapped, fam. Do you feel me? So that's the current place it's currently in. I'm just going to hold again and, just keep it moving like that. The next stock to talk about is PayPal. So PayPal is the worst mover, the top faller for this week, 4.46%. Was Lloyd's higher? You know what? Lloyd's might be higher here. No, 4.27, yeah. So yeah, PayPal is the top mover this week, 4.46%. And again, nothing much has been announced for PayPal, so there's nothing for me to even potentially speculate as to why PayPal's dropped. This might just be the same tech softening that's been happening across the board with a lot of tech stocks, and it has been happening across the board. I mean, if you look at some of the stocks that's on my watch list, Shopify has gone down to, what price has Shopify gone down to? $900. It went down to around $885 at some point this week. It's now at $900, which is much lower than when I sold Shopify and made that 200% profit. Amazon is under $3,000, which is significant. Not long ago, it was nestling at $3,500 a share. So that's gone down extremely significantly. And loads of other stocks have done, pretty much the same thing. So there is still a natural softening within the tech industry. And I think PayPal has been a bit of a victim to that as well. Now, I have sold one stock, and that stock, as you probably would have guessed, is Imperial Brands. So you can see here that I've sold Imperial Brands. I mentioned to you in last week's and I think the week before's portfolio update, when Imperial Brands was the top mover for those weeks, that it's not going to last long within my portfolio. I am going to ride out the fact that it's on a high at the moment, and then obviously when it starts to plateau and soften, I will then make my play to sell it, because I wanted to sell it about 3 weeks ago, but it was doing well, so I thought, what, let me just try and recoup some of the losses that I was doing. And lo and behold, obviously I've just executed against that. So listen, just let me give you some insight to my theories on Imperial Brands and my investment journey with Imperial Brands. I think first of all, this stock was a stock that was up against a considerable amount of legislative and economic pressures, particularly around their vaping business, which I think was one of the key catalysts for Imperial Brands to go in a downward trajectory. So, there was a time, and we're talking about a year ago on these portfolio updates. For those of you that don't know and that's new to the channel, I've held this stock since the beginning. So this stock, I've held for 2 years. It was part of the 1 to 3 year horizon of value stocks that I originally started investing in, UK businesses as well. And I purely based it off the fundamentals. But anyway, one of the news information that transpired during my investment journey was the whole vaping situation in the US and the US cracking down on vapes, and Imperial Brands was obviously heavily exposed to that. So that had a material effect on the business going down. It did pay a great dividend, but it was not enough to really attract more investors, I guess. And so I think as well, you could call Imperial Brands, an archetypal dividend trap. So it's those stocks that I always tell people to be careful of, where I'm typing in the wrong thing. I'm typing dividend because my mind is just thinking about dividends. There's stocks basically that they might pay a really good dividend, but you're going to lose money on the capital gains. So, whatever money you're losing on the capital gains is not going to be offset by the amount you make in dividends. So effectively, it's a dividend trap. And people are going there for the dividends, but the value of the actual capital is going to be depleting anyway. So ultimately, you're going to lose money in the long run, irrespective of whether obviously you're getting the dividends or not. Now, it's very hard to notice a value trap when you start investing in a stock. You don't know it's a value trap. The whole point of value investing, and this is why I talk about what type of investor are you? Are you dividend, growth, value, contrarian, whatever? The whole point of value investing is finding beaten up businesses that historically have had a good track record, that hopefully are going to be turning the curve to be doing well. This is the Warren Buffett philosophy. This is the Ben Graham philosophy. If you've ever read the book, The Intelligent Investor, that big red book, which is typically the, investor Bible, so to speak, of what people tell you should be reading, then this is all it talks about. It talks about, value businesses, finding safe, sturdy companies that pay a reliable dividend, that have had a very hard time, that are looking cheap from a valuation and an earnings perspective, a price in relation to its earnings perspective, and then obviously investing at that point. So you're buying low with the hope that that business will turn around, and obviously you'll sell high. So when I invested in Imperial Brands, I'm not investing in a growth stock the same way I invested in Shopify, as an example. I didn't invest in a business thinking it's just going to shoot up, like a tech stock would. I invested in it because I felt that I'm going to get a sustainable dividend, and over the 1 to 3 year period, it's going to gradually increase, and obviously I'm going to be getting a lot more value out of that investment. Obviously, that doesn't always transpire, and in this case, it didn't work out, which is fair. And so I basically ended up at around a 21.3% loss, and that includes the dividend. So ultimately, I lost about 20% of the money that I invested within Imperial Brands. And you can see, obviously, me investing into this business since, 2018 and so forth. Now, from an ethical front as well, it definitely doesn't align to my values. Early on, I made decisions purely based on the fundamentals. So I didn't really want to make any emotional decisions when I started investing. I literally, of the 300 stocks that was available on free trade at the time, I basically, picked stocks that I felt were undervalued, that have a good chance to obviously grow and pay me a sustainable dividend. That was effectively the thesis that I was working with. And so it really didn't bother me that the industry was obviously, a cigarette or a tobacco industry, and obviously it's an industry that kills a lot of people, or, causes a lot of illnesses within people. I was looking purely based off the balance sheet. Had I known now what I knew then, or had I known then what I knew now rather, obviously I probably would have made slightly different decisions from an ethical perspective. But, that was basically the focus. So for those of you that want to know, why did you do that, then I just want to obviously be clear with you that that's how I looked at it. I looked at it purely based off the numbers, because I was a new investor and I didn't really want to make any decisions that weren't numerical based or backed by the balance sheet. That's basically the theory that I had. I did average down during the course of it going down. So originally Imperial Brands was doing quite well for the first 3 months, or first 4 months. If you look at episode 1, 2 and 3 of my portfolio updates, you'll be able to see that Imperial Brands was doing quite well. So it was going up for about 3 months, and I thought, you know what, I got in at a good time. I made the right decision, and it's going to continue to do so. But then it started to go down. Obviously, I kept on averaging down, as you can basically see here. And I talked about averaging down Imperial Brands on multiple occasions. So had I not averaged down, I would have pretty much sold at a 48% loss. So selling at a 20% loss shows that averaging down did work. Could I potentially have got it down to 10%? Could I have got it down to 5%? I think mathematically speaking, yes. However, it would have just taken a lot more patience and probably a lot more time. And ultimately, I just felt like it's not the right time to do that. I'd rather take that money out. My ISA allowance is pretty low, which is what I mentioned to you guys last week. So I need more cash on hand that I can then effectively, deploy to other tech stocks, or to increase some of the holdings of my existing positions. So, positions like Cloudflare that I generally believe in now over a 5-year period is 6% down. I could be adding some of that Imperial Brands money to Cloudflare, or maybe even to Lloyd's, or, to some other holding that I potentially have or desire that's in my watch list. So, it felt like the right time to obviously, pull the trigger on Imperial Brands. I don't regret any decisions I make as an investor. I don't care if like the first 3 years I make no money investing. For me, this is like a lifelong discipline. So it's like going to the gym and trying to get hench after the first year. Like you got to be doing it consistently, and then obviously you'll reach your body goals, you know, after years, right? So for me personally, it doesn't really bother me that I lost 20% on Imperial Brands. It doesn't bother me in the slightest whatsoever, and I really value the learning experience that I had. And I've always said, you know, sometimes you learn from being burned, and that's like one of my phrases. So sometimes you have to put skin in the game, you have to actually put your money on the line, you have to actually put it up and obviously see what happens, and then through the experiences you will learn what happens. So yeah, I'm definitely, you know, happy that I've sold it now. So I'm not gonna lie to you and cap that I wish I held it and averaged it down more. I'm kind of happy I've got rid of it, and I'm happy to just take the little bit of an L that I took, and you know, we're just gonna keep this moving and going forward. Now I've made one dividend payment, or not made it, I've earned one dividend payment this week, and you can see here that's Centamin. So Centamin paid me a dividend of £58.70. And again, Centamin was one of the original stocks that I've held, but unlike Imperial Brands, it's done the complete opposite. I was buying Centamin when it was around 90p, and obviously now it's £2.13. But the reason why you don't see 200% is because my original strategy was dollar cost averaging, which is now slightly changed for certain stocks. Certain stocks I lump sum and I just leave it, and I just average down if it goes down. Other stocks I might add to it on a monthly basis, but typically I haven't been adding much to it. I kind of left it. I think the last time I invested into Centamin was, you know, was a year ago. I haven't invested into Centamin for like a whole year. So yeah, that's the situation there. But yeah, I'm more than happy to continue holding Centamin. This is my hedge. This is my slight hedge against the UK economy for one, and obviously just equities in general. Obviously it tracks gold, and it is a good business fundamentally as well. So yeah, this is a business that I'm definitely going to continue holding. And yeah, that's the portfolio for the update for this week. Hopefully you found it useful. If you did, like, comment, subscribe, ring that notification bell, get in the comments with any questions, and listen, I will catch you next time with another investment video. Take care, guys. Peace.